Hello everyone, I'm Karthik from ITI section and my roll number is 1230. Today on before my topic is about Cobb Doggle's production function and the case of converging economy. So let us know what is this Cobb Doggle's function and the case of converging economy in further slides briefly. Let us dive into our topic. So coming to the abstracts, the Cobb Doggle's production function is often used to analyze the supply side performance and a measurement of a country's productive potential. This functional form, however, includes the assumption of a constant share of a labor in output, which may be too restrictive for a converging country. For example, labor share in the Czech Republic gradually increased over the last decade. In this paper, we test whether this fact renders the application of the Cobb-Douglas production function unreliable for the Czech economy. We apply more general form of production function and allow labor share to develop according to the empirical data. Introduction. The performance of the supply side of an economy is often identified with the growth rate of potential output. Potential output is not observed in reality. However, it has to be approximated. The use of production function method for the measurement of potential output growth takes into account different sources of an economy's productive capacity, namely the contributions of labor, capital, and a total factor productivity, the latter containing information about technological and allocative efficiency and hence about the supply side functioning. Using the production function, one can discuss changes in the supply side performance on the basis of the observed simultaneous developments in the quantity of labor, capital, and the total factor productivity. The practical application of the production function method requires making a certain assumption, particularly one can functional form of the production technology returns to the scale and the characteristics of the technological progress as well as the functioning of markets. The neoclassical two-factor Cobb-Doggles production function with the Higgs neutral technology is frequently used to including the assumption of a positive and diminishing marginal products with respect to inputs of labors and capital. Constant returns to scale, no unobserved inputs, and perfect competition. This assumption restrict the elasticity of output with respect to labor and capital to values between 0 and 1 and their sum to being equal to 1. Given the assumption that theoretical technological coefficients are then is practice approximated with the help of the income share of labor in produced output. Since the technological coefficients are assumed to be stable, the share of factors in production should be stable in the time. The Cobb-Doggles production function. DFHH basically follow Guarino and model at the potential output using the two-factor co-production using with the Higgs neutral technology, where YLKA are a real GDP labor input, a capital input, and the total factor productivity level respectively. There are two methodological advances used by DFHH that are worth mentioning. The first, they incorporate the concept of time varying Nairo into the production function approach to derive potential labor and the second they newly introduced the concept of capital services to adjust the aggregate capital stock with respect to the real product impact of this factor input. The specification of a production function is a special case of the constant elasticity of a substitution production function with the elasticity of the substitution equal to 1 and with the usual theoretical assumptions used in the empirical literature. As mentioned earlier, positive and diminishing marginal productions of each input are assumed. This restricts both L and U values to between 0 and 1. Second, returns to scale are assumed to be the constant, that is U bar equal to 1 minus L. So here is a figure trend total factor productivity and potential output from 1995 to uh, 2005, which are of four quadrants it has taken, and TFP levels are between the basic index where from a 1995, which is a quadrant 1, that is equal to 100, and the GDP and the potential output, TFG growth and potential output. So in the first quadrant we can see the TFP levels, which are been increasing from starting to ending, that is from 1995 to 2005 it is been raising, and the drastic change is coming from 2000 to 2005 where it has increased a lot. And coming to TFB growth, here it started at a good point, but it has been decreasing and increasing, some up and downs, and we can see it has raised slowly from 1995 to 2005. It has seen many up and downs. So, and coming to the GDP and potential growth, it is been uh, constant, and the potential output is constant, and output is near to the constant and consistent. And coming to the potential output, this is also same. It has been decreasing and increasing, and at last in 2005 it is at a good point or at a good state. Figure 1 shows the basic results of a DFHH that are relevant for our analysis. The estimated potential output growth is not a primary importance for the economy inference. However, indeed, given the technique used, the potential output is always a smoother version of the observed output. It is evident that development of the trend total factor productivity is viewed as the critical for the evaluation of a supply side performance. In a nutshell, whereas the second half of the 1990s is evaluated as a period of inefficiently working supply side. Given the stagnation of the trend total factor productivity, the period from 2001 onwards is evaluated as a period of a more efficient use of resources. Simple because of the positive growth of the trend total factor productivity. In section 3 and 4, we evaluate where this conclusion holds even if we apply a more general form for the production function. Labor share, a case of converging economy. The unusual assumption of a constant labor share may not be fully convenient for an economy that has not reached its steady state and is still in the progress of economic convergence, which we believe characteristics the SEC economy. The question we therefore ask is to which extent the assumption of a constant labor share influences the results. In our alternative setting, we abandon the assumption of a unit elastic of substitution between labor and the capital and adopt a more general form of production function, what that would allow to change over the time, assuming that they asymptotically converts to their state of lives. Here, the labor shares the trend total factor productivity in labor share from 1995 to 2005. It has been increasing, and TFP growth at starting state it has seen the downfall, but gradually it increased, and in 2005 it has increased totally. Figure 2 clearly shows a gradually increasing in the labor share over the whole sample. This indicates that the assumption about its ongoing convergence towards a steady state may be relevant. In addition, it is important to recognize that DT ignores a temporary movements in the labor share that do not reflect the trend developments on the supply side that could obscure the picture. The result for TFP, however, shows a limited impact of this change for the story about the supply side. Basic comparisons: the move from the constant share of a labor D to time varying dt does not have a significant impact on the estimated trend total factor productivity. For the constant labor share, total factor productivity has a product contribution to potential outputs dynamics only after the year 2000. The same holds for the gradually growing labor share. To put it strictly technically, the observed difference via the case is a constant D is caused by the fact that given the growth of the capital input being higher than the labor input, allowing the D parameter to increase makes that the contribution of the capital to the potential output growth higher in the beginning of the sample. That is where values of the study are lower than the average value used in the case with the constant D and lower therefore after given the sample values of the observed output, the residual total factor productivity are just coming to the conclusion, there are little doubt that the Czech economy has experienced a relatively slow annual average growth in the potential output of the around 2.5 to 3% over the last 10 years, with a tendency to accelerate from 2001 onwards. A common story about the low level of the economic growth in the second half of 1990 seems to be that of a slowly growing or even a stagnating a trend totally of factor productively during that period. This may consequently be interpreted as the evidence of the clear inefficiency in the supply side functioning that only from 2001 onward indicates a certain degree of improvement. A conclusion like the one above is based on the application of the standard production function methodology to the Czech economy. At the same time, however, there may be doubts about the robustness of the results given in the shortcomings of the methods used in the recent studies. Example, the applicability of all assumptions for a converging economy. A particular question we raise in the studies is the frequently used assumption of a stability of factor shares the total output. This is about our topic, Cobb Doggles, the production function. Thank you.